What's up, rich friend? Today I am putting two of the hottest dividend-paying ETFs head-to-head. That's JEPQ and JEPI. If you're looking for passive income, these two funds promise juicy monthly dividends. But the question is, which one should you actually buy? By the end of this video, you're gonna know which ETF pays the bigger dividends, which one has the better long-term performance, which ETF is riskier, because let's keep it real, higher dividends usually means higher risk, and my final recommendation on which one of these two makes the most sense for you.
We getting money, money, money. When Jameer sharing gems with her getting money, money, money. Getting a line, growing money and getting money, money, money. It's your life, trying to give more life. Getting money, money.
Before we dive in, make sure that you like, comment, and subscribe to the Get Money Show. And hit the bell for notifications so you never, ever miss any of my future episodes that help you get to $1 million and beyond. Also, make sure that you download my 100% absolutely unequivocally free list of 26 monthly dividend paying stocks. I've got the link for you right in the description. And if you want to take your wealth, truly take your wealth to the very next level, join my rich friends. The link to details for my group is in the show notes as well. Let's get into it. All right, first things first, what is JEPQ and what is JEPI? Both of these are ETFs, and if you recall, as we've discussed before, ETFs are essentially a basket of stocks, offering instant diversification, thereby helping you mitigate the low downturns of the stock market, but also helping you when the highs are higher. Now, both of these are JPMorgan run ETFs, and JEPQ focuses mostly on tech stocks like Apple, Nvidia, and Microsoft. Whereas JEPI focuses on blue chip stocks from the S&P 500 like McDonald's, Visa, and MasterCard. So JEPQ is more aggressive with tech stocks, while JEPI is more balanced with dividend-heavy companies. Again, like I said, both of these ETFs are run by JPMorgan, and they focus on one thing: generating passive income by selling options on stocks that they own. This is what is called a covered call. Don't worry, I'm going to explain to you exactly what a covered call is right now. Okay, now stay with me here. I'm going to give you some possibly new investing vocabulary words, but I'm going to explain everything in detail so you can understand clearly what's going on. All right, let's talk about what a call option is. A call option is a contract that lets a buyer purchase a stock at a set price, also known as the strike price, by a specific date. Investors buy call options when they believe the stock price is going up because they want to lock in the lower price. So here's an example. Let's say XYZ stock is $180 per share today. We have Joe, and Joe is a buyer. So Joe buys a call option from Maria, who is a seller. When he buys the call option, Joe sets the strike price at $190, and he wants it to expire in 30 days. Now, if the price of XYZ stock jumps to $200 within those 30 days, Joe gets to buy that stock at $190. Instead of $200, thereby making a profit. Now, let's talk about the strike price for a second. The strike price is the price at which the option buyer can purchase the stock. If the stock price never reaches the strike price, the option expires worthless, and the seller keeps the money from selling the call option. So, let's go back to our previous example. Remember, the stock price was $180, but Joe, the buyer, set the strike price for $190 for 30 days because he thought that the stock was going to rise significantly within that amount of time. So he was able to pay only $190, even though the price jumped up to $200 within those 30 days. So in this example, Joe made a profit of $10 per share because Joe paid $190, the stock price was $200, 200 minus 190 is 10. So Joe only paid $190 for a $200 stock. That's what a call option is. Now, let's talk about what a covered call is. Here's how they work. Now, remember our seller, Maria, right? We're going to revisit her right now. So a covered call is when an investor, like Maria, owns the stock and sells a call option on it to generate income. Think of this like renting out a car that you own. You still own the car, but you're making extra cash by renting it out. Here's how this works. So Maria, in this case, is the seller of the call option, and she gets paid upfront. This upfront payment is called the premium. If the stock price stays below the strike price, Maria gets to keep her stock and the premium. That's free money that Maria just got. But if the stock price goes above the strike price, then Maria has to sell her shares at the agreed upon price and miss out on any gains. So let's run our example back. Joe bought a call option from Maria for $190 strike price. The price shot from $180 all the way up to $200 within those 30 days. Because the price went above the strike price, Maria had to sell her shares to Joe, the buyer. She still made money, but not as much money as she would have if she had been able to keep the stock and benefit from that $200 upside. On the other hand, let's say the stock price is still $180 now, and Joe the buyer still set his strike price at $190. But within 30 days, it had only gone up to $185. In that case, Maria, the seller, gets to keep her stock and the premium that Joe the buyer paid when he bought the call option from her. Eventually, if that stock price ends up going up to $200, Maria gets to participate in those gains. So when it comes to JEPQ and JEPI, here's how I want you to think about this. Think of both JEPQ and JEPI as Maria the seller. These ETFs own the stocks and they sell call options on those stocks to collect premium payments. The premiums become part of the dividends that you receive every single month. So that's why both of these ETFs have a higher than average dividend yield, which we'll talk about that shortly. Both of these ETFs trade potential stock gains for steady income. Okay, let's breathe a little bit. So now that you've got that part, and now you understand how these ETFs make money and why they are different from other traditional ETFs, let's go ahead and compare JEPQ to JEPI. First, let's talk about the holdings in each one of these ETFs. And a lot of companies in JEPQ overall can be found in the NASDAQ 100, which is known to be a very tech-heavy index. All right, so the top 10 holdings in JEPQ at this time that I'm making this episode is Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Broadcom, Tesla, Netflix, and JPMorgan. So you're getting really big tech exposure when you invest in JEPQ. Now let's look at JEPI. JEPI's top holdings are more focused on what's in the S&P 500 and therefore has far less volatility. Their top 10 holdings are Meta, Amazon, MasterCard, Visa, Progressive, Alphabet, Train Technologies, Thermo Fisher Scientific, Southern Co., and AbbVie. JEPI holds safer blue chip stocks with solid track records. Even the tech that it holds is more tried and true tech that have performed exceptionally well over long periods of time, like Meta, Amazon, and also Alphabet, which is Google. So now that we have a clear lay of the land in terms of what's inside of each one of these ETFs and we know what we're getting into, let's look at the price of each one of these ETFs. As of the time that I'm making this episode, JEPQ is trading at around $52 per share, whereas JEPI is trading at around $58 per share. Not an enormous difference in price per share, it's only a $6 difference as of the time I'm making this episode. However, you do have to remember that once you start buying multiple shares, $6 balloons into a lot of money. So if you were buying 100 shares, for example, and you were trying to decide which one of these you should purchase, well, that's a difference of $600. Add an extra zero, and if you were looking to buy 1,000 shares, now you've got a difference of $6,000. Obviously, if you add another zero and you're looking to buy 10,000 shares, that's $60,000 worth of difference, right? So the more shares that we buy, the more impactful that $6 difference is. So again, when we just look at the individual price per share, it's not an enormous difference, but JEPQ is the winner here because the price is lower. Okay, so now let's talk about the dividends. JEPQ's dividend yield is about 11%, really high, which is great. That means that you're going to get a significant amount of dividends paid out to you just for owning this ETF. JEPI has a lower dividend yield of about 8%. Still high, but not nearly as high as 11% coming from JEPQ. So let's run some numbers here. If you invested $10,000 today, JEPQ will pay you $1,100 per year absolutely passively without you having to do a single thing, whereas JEPI will pay you $800 per year. Again, passively without you having to do anything extra. That's a $300 per year difference. And you may think like that doesn't really seem like a whole lot over the course of a year. And you might think that that $300 is kind of inconsequential. But again, let's make those numbers bigger. Increase the investment amount over time and those dividends start to look a whole lot different. A $100,000 investment in JEPQ would pay you $11,000 per year absolutely passively, while the same $100,000 investment in JEPI will pay you $8,000 passively. In this case, JEPQ wins here. And while that's a much bigger difference, higher dividends do come with some trade-offs. So let's look at the past performance. All right, so let's talk about how each of these have actually performed in the stock market. Now, both of these ETFs launched within the past 5 years, so we don't have 10-year historical data to go off of. But we can check to see what they have been doing since they've been in the market. JEPQ is up about 16% since it launched, and JEPI is up about 13% since it launched. So JEPQ is the clear winner of this round since it's been outperforming JEPI so far. When it comes to expense ratios, nobody likes to pay fees, but you got to pay to play. Now, the expense ratio, if you don't know, is essentially the fee that you pay to the company that runs the ETF in order to manage it for you. Why do you pay this fee? Well, because they're taking on the task and the burden, if you will, of managing the whole entire fund, right? So if the fund has hypothetically 500 companies in it, in order for you to do the same thing that they're doing, you will have to go out and buy each of those 500 companies. And then you have to manage it. You have to figure out exactly what the right mix is, what percentages you need to have of every single one of the companies in order to make it do what you want it to do as far as growth. Now, that's a lot of work on your part. So instead of doing all of that, when you own an ETF, you're going to pay what's called an expense ratio, which is basically the fee, in this case, JPMorgan, because they run these funds. You're going to pay that cost to them in order to do all of that work for you. And that may sound like a really expensive cost, but it actually does not have to be. The beautiful thing about both JEPQ and JEPI is that they have very, very low expense ratios. And both of them have an expense ratio of 0.35%. That means for every $1,000 that you invest, you're going to pay $3.50 per year in fees. Not bad at all. If you got $1,000 to invest, I'm pretty sure you can swing $3.50. If all I got to pay is $3.50 per year, not per month, not per share, per year, for someone else to do all of that work for me, sign me up. Because my time is worth far more than $3.50 per year. And I'm assuming that yours is too. So don't be afraid of the expense ratios. It's something that you got to pay, but obviously the lower you can get it, the better. And both JEPQ and JEPI have very, very low expense ratios. So just so you have some apples to apples comparison, I should note that the average expense ratio for ETFs that are similar to these two is about 0.94%. So both JEPQ and JEPI are both far less than half of that. So for this round, these two are tied neck and neck. All right, it's time to talk about risk and volatility. Now, risk is where these two ETFs really start to differ. Both of them are relatively new ETFs. So again, we don't have a lot of historical data to go off of to compare their volatility percentages. But what we can do is look at what types of holdings that they have and use historical data from those types of companies to make a strong, educated assumption. So JEPQ is very tech heavy, as we've discussed. And based upon historical data, we know that tech stocks can have some very, very high highs and some very, very low lows. So for that reason, JEPQ could see much bigger swings than JEPI. But with more risk, oftentimes comes more reward. When the economy is doing well, JEPQ will skyrocket. But when the economy is down, JEPQ is going to take a really, really big hit. On the other hand, we've got JEPI. And JEPI has a lot lower volatility due to just having more stable companies. But that can also mean a lower upside in terms of money that you can make. Since we're only looking at risk here, this one has to go to JEPI because less volatility means less risk. And the lower the risk, the better. Now, I'm clear that more risk can mean more reward. So right now we are just talking about the risk category independent of performance. So for that reason, JEPI wins this round. All right, so we've done a pretty thorough analysis of these two, JEPQ and JEPI. So which one should you buy? Well, let's look at the board. As of the time that I'm making this episode, JEPQ wins for price because the price is lower. JEPQ wins for dividend yield because the dividend yield is higher, meaning you'll make more passive income. And JEPQ also wins for past performance because it has performed better than JEPI over the time they've both been on the market. JEPI wins for volatility because it has lower volatility and therefore less risk. And both JEPQ and JEPI are tied for expense ratio because they are the exact same in this category. When we compare all the categories that we've discussed, JEPQ clearly beats JEPI. Now, which one would I suggest for you? For most investors, I would say that JEPQ is the better long-term pick. It is more volatile, but if you're in the market for the long term, JEPQ pays an amazing dividend, which is free passive income that you don't have to work for. It costs less per share, and it has performed better over time. And due to the holdings that are in the fund, I believe it's going to continue to do better over time. But I do have a caveat. The one you should personally invest in is going to depend on your goals. Go with JEPQ if you want higher dividends, a lower price per share, and if you are more risk tolerant. Also, if you believe that tech stocks are going to continue to grow. But go with JEPI if you want consistent income with less volatility, if you are more risk averse, and if you prefer blue chip stability over tech heavy risk. Now, if you stay to the end, do me a favor and comment the word YOLO, YOLO, in the comments so I know that you stayed till the end. And let me know, which ETF are you going to go with? JEPQ or JEPI. Lastly, if you enjoyed this head-to-head comparison, let me know what other ETFs or stocks you would like me to compare to each other, and I'll be sure to add it to my list. Don't forget to download my free list of 26 monthly dividend-paying stocks. The link for that is in the description. And if you liked this and you want more exclusive info on when certain stocks are predicted to go up, when stock splits are happening, thereby allowing you to get more shares for absolutely no cost, and how to make a ton more passive income by utilizing the stock market and utilizing it smartly with strategy, join my rich friends. All the details about it are at the link that's in the show notes. Like, comment, and subscribe to this channel, you guys. Thank you so much for being here, and thank you for helping me grow this channel and this community. I'll see you in the next video. Talk to you soon. Peace.